Hey everyone, my name's Imran from Modus Academy.
Hi, I'm Emelie.
And my name is Nana. And this week we're gonna speak about traditional mortgage versus Sharia mortgage.
Ooh, traditional mortgages versus Sharia mortgages. I guess before we start talking about this, none of us, you guys, me, we're not mortgage brokers, are we? We're not financial advisors. So please seek financial advice, but we want to give you, I guess, our thoughts, my thoughts and opinions on the differences. So is this sort of a question that you guys get that come up sort of in with your network?
Yeah, and a lot of people get offered Sharia mortgages just because it's better rates for overseas investors. So we thought that, but they really don't know maybe all of the perks and cons with it. So we thought maybe we should go through it.
Yeah, definitely. So I'll give you my thoughts and opinions on it and how I see sort of maybe the key differences. So maybe let's talk about that to begin with. So in my mind, and again, if you are a Sharia compliant mortgage broker, you can correct us if we're wrong. But in my mind, a traditional mortgage, just to be very clear with everyone between the two. So a traditional mortgage, if you guys, so say you guys are buying a property or are buying a buy-to-let or a HMO, we own 100% of that property. So we buy the property under our name or our limited company name, and we own the asset. The bank put in maybe 75% of the money to borrow towards a purchase, and we put in a deposit, but we own the entity, okay? We own the asset. So that's a very traditional mortgage. A Sharia compliant mortgage is slightly different. You're almost partnering with the mortgage company, if that makes sense. You would go into like a partnership. So you don't actually own the property in 100% entirety. So you own a percentage of the property. So say, for example, you put in a 20% deposit into that deal. So you own 20% of the asset, right?
Yeah.
The bank or the partner put in 80%. So they might put in 80% of the money, almost like a mortgage, but that's their stake of the deal, okay? So they own, in effect, 80% of it, okay? And over time, you will buy back a percentage of that property, if that makes sense. Yeah. And on that 80%, you pay basically a form of rent rather than a mortgage payment, if that makes sense.
Yes.
So it's a slightly different scenario. So Sharia is about partnership in property, and you own a smaller stake, but you buy more over time. And traditional mortgage is where you do own 100%, and you take out a mortgage, but it's a very different legal setup and structure. I think that's the first point. Would that be fair? Is that clear, guys, and your thoughts as well?
Very good explaining.
Yeah, I couldn't have explained it even better.
I don't know. We try, right? We do try. But it's interesting because I think people think, well, do we go down that route? Because like you said, it's attractive. It's a better interest rate. And I think for internationals, it can be a better interest rate. But it doesn't mean that it's the right deal for everyone. Because sometimes a Sharia compliant mortgage might mean that some of those lenders may not look at properties that need refurbishment. So they might say, oh, we won't look at a deal if it needs refurbishment. They might not look at HMOs. They may not. I know some investors, when I looked at a Sharia mortgage with a coaching client, they would do buy-to-lets, but at that time, they wouldn't even touch a HMO. So I said, look, if it's a buy-to-let property, we'll do it. So I think it depends on people's strategy in terms of whether it's the right mortgage for them. I think the key thing to understand of why it's there is that in the sort of Islamic law and their sort of their culture and belief system, they sort of cannot gamble, okay, and they cannot sort of have betting, and they can't have forms of interest, and that's why these mortgages exist today, because sort of interest is seen as haram, it's forbidden in terms of how they do things. And it's ironic, you see so many Asian people that are property investors. So they either buy cash or they buy with Sharia lending. Some may take out mortgages, but of course they don't really want the mortgage because of the interest element, okay? So the key difference here, one of the key things that could be good for a Sharia mortgage is sometimes they will go up to 80% loan to value. So that's good, because they put down more money into the deal, so you need less money going into the deal, and it is asset based, so the risks are slightly different because 80% loan to value. The interest rates as well can be quite attractive for international investors, because I know that some international investors are still paying quite high interest rates on mortgages. What sort of rates are you seeing at the moment, guys?
Well, it depends on the value of the property totally. Like over 100K value of the property, then we can go down to like 4.
Yeah, 4 or 5. It all depends.
And if the value is less than 100 grand, and the rates go up, like I think the best we've seen that is like 5.69.
Yeah. So it's interesting. So I think though, so because Sharia don't charge a mortgage payment, they charge a rate of rent. So they will calculate it, and it will be somewhere around 4 to 5%, I would say. So they charge you that as a monthly rental payment that comes out every month, basically, almost like a mortgage payment, but it's a form of rent, and then you down pay over time. And I think this is the key thing, that you have to remember you're a partner in the property, and there's normally like what I call a fixed rental period. So for the first, say, 2 to 3 years, there might be a fixed rental period, and then it would go into a different rental agreement after that term. Okay. So the one thing you must be, I think, cautious of is that understanding what is that fixed, what is the term after the 2 to 3 year period. Will the rent shoot up, for example? So will it become as attractive? So I think it's important to, if you're ever having conversations with a Sharia compliant broker, to ask about the longer term plan. So I think that's really crucial when you're doing this. The other benefit though between a traditional mortgage and a Sharia mortgage is traditional mortgages, when you take out a mortgage in the UK, they always have something called an ERP, an early repayment charge, or ERC. So what that means is that if you have a mortgage for 3 years at a fixed interest rate at say 4%, if you then sell the property within that period or remortgage, they're going to charge you a percentage of that mortgage as a fee. So traditional lenders will charge you maybe 2, 3, 4%, and normally it goes down over time. Because again, Sharia mortgages do not comply with interest. They don't like interest. So there's no early repayment charge with a Sharia compliant mortgage. So that is a bonus, okay? Because it's not a lending arrangement. So they can't charge you a fee for exiting a lending arrangement, because it's more about partnership and coming together. So I think those are the pros in terms of it could be more attractive from a rates point of view. The loan to value could be higher potentially, which is good. There's no early repayment charge potentially as well on the mortgage. Sorry, not on the mortgage, on the rental aspect of it. Okay, so from that side, I think that's really cool. I suppose the cons of it is you don't own as much of the property at the beginning. You're in partnership. So you have to be aware that from an ownership point of view, you don't own all of it, but you can buy more ownership over time. You can down pay that, so the more you pay over time, the lower your rental payments will be on it. And it's very similar to a scheme in the UK, like the Help to Buy scheme or part rent, part buy scheme. It's very similar to that sort of structure. Whereas traditional mortgage, you own 100% of it, but you will pay interest on that money, but you have probably a bit more control over the asset, if that makes sense. So I see those as the key differences. Would that be fair to say?
It's a very good explanation. And from what we experienced, because we've been looking into bridge lending too, if you have a Sharia mortgage on your, for example, buy-to-let property, you cannot use that. Maybe some will, but the people we've been speaking to, they can't use that house as security against the bridge, because they don't own the house.
And that's a really good point. So that's great. So you're absolutely right. If you've bought a property with a buy-to-let lending facility under Sharia compliance, you're right. Because of the slight complexity of ownership, you can't then use that as security to buy that next deal using a bridging loan or that asset as collateral towards a deal, because you don't own it. And that's a really good point, Emelie. Really well said. Because if you're looking to grow your portfolio, they might say, okay, we can get some great rates of bridging lending, but that asset now isn't security for you. So if that's your plan, you're actually better off going down the traditional route on your first deal. Maybe it means your interest rate is slightly higher, but if your plan is to use that deal as leverage for future purchases, then you do need some flexibility in there. So that's a really good point. I think I would see Sharia lending as more like exit finance. So maybe it's better for like going with bridging or buying cash and then using that as almost like an exit lender, because the loan to value could be good. You're lending then on a ready-made product. But have you seen people do HMO lending? Have you heard of anyone that does HMO lending?
Not with Sharia.
No, same here. I've only ever seen people and clients do it through buy-to-let lending, not on HMOs. And I think that's where their market is really. The product was built more for homeowners. But I think over the years, certainly over the last few years, I've seen lots of those compliant mortgage providers go down the route of lending to investors or lending to limited companies that buy assets. So they are obviously going down that route too, but it's it feels very complex, but I've tried to keep it very straightforward and simple. So just less home ownership, you pay rent on the bit you don't own, basically. Just be aware of the longer term plan when you're doing when you want to exit that finance. But yeah, really good points.